Hey everyone, and welcome. Today, we're going to dive into a topic that, is absolutely crucial for any investor out there: capital gains tax. I know, it sounds a little intimidating, but trust me, by the end of this, you'll get exactly how it works and what it really means for your money.
So, have you ever sold something for more than you paid for it? Maybe a plot of land, some shares in a company. If you've ever made a profit like that, congrats. You've just experienced what's called a capital gain. And we're about to break down exactly what you need to do next.
All right, let's start with the absolute basics. At its heart, capital gains tax, or CGT for short, is just a tax on the profit you make when you sell an investment. Think of it like this: when your asset goes up in value and you cash in, the government gets a small piece of that success.
But hang on. Before we get into all the numbers and details, we have to ask the most important question first. Is the thing you sold even taxable to begin with? Honestly, this is the very first hurdle we've got to clear.
See, the tax authorities make this really crucial distinction about something called an investment asset. Basically, this means it's an asset you're holding with the hope that it'll grow in value, not something you're using for your regular day-to-day business. So, for example, buying a second apartment to rent out, that's an investment. But the delivery van you use for your bakery? Nope, that's not.
So, what actually is a capital asset? Well, you might be surprised at just how broad the definition really is. We're not just talking about the obvious stuff like land or buildings. It also covers your stake in a company, any financial securities, and even things like options or rights connected to those assets. It's a pretty wide net.
And just as important is knowing what isn't a capital asset. So, if you're running a business, the things you buy and sell as part of your normal operations, your inventory or trading stock, they don't count for this tax. And the same goes for assets used in your business that lose value over time. The depreciable ones.
Okay, now for some really good news. Even if what you sold is technically a capital asset, there are a couple of really important exceptions that get you off the hook completely. Right, so there are two huge exemptions you need to know about. First is your main home, your primary residence. It's usually exempt as long as you've actually lived in it for at least 2 out of the last 3 years. And second, and this is a real game changer for stock market investors, shares you trade on the Colombo Stock Exchange are completely exempt. That's a massive incentive to participate in the local market.
So, what happens if your asset is taxable and it doesn't fall into one of those big exclusions? Well, don't worry. You still might not have to pay a thing. There's another layer of exemptions that's designed to help out with smaller gains. For resident individuals, this is the number to remember: 600,000 rupees. This is your personal, annual exemption. It basically means the first 600,000 rupees of total capital gains you make in 1 year are totally tax-free. But as always, there's a little catch, and it's a really important one. Well, that 600,000 rupee number is your total for the whole year. Any single gain can't be more than 50,000 rupees to qualify for this specific relief. So this is really meant to cover a bunch of smaller, more modest profits, not one big windfall. Okay, so you've figured out your asset is taxable, and you're not exempt. Now it's time to get practical. Let's figure out the bottom line. How do you actually calculate the tax you owe? The whole calculation kicks off with the asset's cost. But listen up. There's a special rule here for things you've owned for a really long time. If you had it before September 30th, 2017, its cost for tax purposes is whatever its market value was on that specific date. So once you've figured out your profit, by subtracting that cost from your sale price, you apply the tax rate. For individuals, it's a flat 10%. Pretty straightforward. For companies, though, it's a whole different story. It's a much steeper 30%. That's a huge difference depending on who or what owns the asset.
Now, what happens if you actually lose money on a sale? This is a super important point. You cannot take a loss from one investment and use it to cancel out or reduce the taxable profit from another one. Each gain stands on its own and gets taxed on its own.
All right, you've done the math, you know what you owe. Now comes the final, and maybe the most critical part of all, making sure you file your return and pay that tax on time. When it comes to the deadline, you have to move, and you have to move fast. The number you absolutely need to burn into your memory is 30. You have just 30 days. And here's the kicker. It's not 30 days from when you made the sale. It's 30 days from the end of the month in which you sold it. That's a really tight window, so you have to be ready to go.
So let's break it down into a super simple 3-step action plan. Step 1, calculate your profit and the tax you owe. Step 2, pay that tax. And Step 3, file the official CGT return. And the most important part,
All three of these things have to be done inside that same 30-day window.
And where do you actually submit all this? Well, you've got a few options. Doing it online through the e-services portal is probably the easiest way, but you can also do it the old-fashioned way and file in person at a regional inland revenue office or at the Central Document Management Unit in Colombo.
You know, to really bring this all home, our source material has the perfect summary of everything we've just talked about. The key takeaways? That 10% rate for people and 30% for companies. Those major exemptions for your home and listed shares. And of course, that crucial 30-day deadline for both paying and filing.
So there you have it. You've got the roadmap for capital gains tax, what it is, when it kicks in, and how you handle it. Which, of course, leads us to the biggest question of all. Now that you know the rules of the game, how are you going to adjust your strategy to make sure you win?